Okay, welcome back, everyone. Today we are going to be talking about covered calls in the stock market. So, what are covered calls? A covered call is a financial market transaction in which the seller of a call option owns the corresponding amount of underlying instruments, such as shares in stock or other securities. So, basically, what that means is say you own 100 shares of a company. You can sell a call option for a premium, collect the premium, and if the call option hits a certain value, then you sell your shares at that price to the other person. So an example of this would be Apple. So if you own 100 shares of Apple at $133, and the current share price is $134.98, you can sell a covered call at $135, which is the strike price, meaning that if by April 23rd, 2021, Apple reaches $135, you get your shares called away. But you could sell that contract or covered call for $172 premium, which means you pocket that $172. Now, if Apple maintains a price of $135 by April 23rd, you would sell your 100 shares to the person who bought the contract for $135 while keeping the $172 premium. So that would be a $372 profit from when you initially bought Apple at 133 compared to selling for $200 profit once it hits 135. So you would basically make an extra $172 in a week. And if you were to sell a monthly, it could probably be around $800. And so why would you implement this covered call strategy? It's used as an exit strategy. So say, for example, you had the Apple shares and you want to sell at $135. You can now sell at $135 by X time, so by April 23rd, and maintain that premium. Instead of just selling individually for, say, $200 like you would have, you would actually collect an extra $172 on top of it for the covered call. So it's used often as an exit strategy to get out of stocks, and it also increases yearly return. It's also a relatively safe way to leverage your assets. So say you're really good at the stock market and you follow one stock in particular, and you know that on average they raise 2% a week, and you don't want to sell your shares. You can sell covered calls at 2.5% a week outside at a strike price that's a 2.5% above the current stock. So if you were to sell, say, Apple, and it goes up 2%, then you would maintain your shares while also keeping the premium because it didn't go up that 2.5%. So you wouldn't get your shares called away. So you would maintain your 100 shares while also collecting a premium, which would increase your yearly return by the premium amount every week or every month. And you can also receive like a monthly premium. Usually you want to sell monthlies if you're trying to increase your yearly return. And you still have a small amount of downside protection. So that $172 premium, if Apple were to drop, that can be used as downside protection. And so the risks, if you sell a covered call and a current stock price falls, so say you own Apple at $133 and you sell a monthly, which means you're trying to sell it a month out. You can sell your covered call, but if Apple drops to 130, you cannot sell your shares until that monthly is expired. So say the world's biggest scandal were to come out and Apple dropped to $5 a share. You would lose $130 on each share, which would be a $13,000 loss on the actual option. So that's the biggest risk, is you lose money if the stock price falls and you cannot sell because you're stuck in a contract where you might get your shares called away. Now, if you sell a call option that isn't covered, which means you don't own the 100 shares itself, you have a risk of being margin called, which means you'll have to provide the funds and buy the shares. So if you don't have the capital to purchase the shares, then you can definitely get margin called, which leads to a massive risk. The other risk is if, for say, in the case of Tesla, you were to sell a monthly call and the share price went up 200%, you still make profit off the premium and the strike price, but you lose all the potential profit that you could have made because you're selling your calls at that price. So instead of selling your calls at maybe, or your shares at maybe $300, you would sell at $150 while collecting the premium. So that's another risk that you have to take into account. And that's basically what covered calls are. They're extremely useful if you can get very good at them and actually increase your yearly return exceptionally. A lot of people that I know that do covered call strategies can get up to 30% returns yearly, which beats the S&P 500 by around 23%, and can exceptionally grow through compound growth and making millions and millions of dollars. So definitely look into the covered call strategy. And next week we are going to be talking about cash secured puts and selling puts, buying puts, which is basically the opposite of a call. Awesome. Thank you, everyone.